Salut. Do you think you know all there is to know about portfolio rebalancing? It's basic stuff. You pick some asset allocation like 60/40, and you just rebalance it back to 60/40 whenever, like maybe every year or whenever the allocation strays too far from your target. I want to share with you there are actually other ways of doing it besides just that, and there are some pretty significant advantages to them too. And I would add that most people probably don't know about them. So we're going to go through that today along with some examples. So first, just a disclaimer, as always, I am an electrical engineer. I am not an investment professional. You might want to pause the video and read these bullets here. Today's video is for entertainment purposes only. So the best way I think to illustrate the three sort of rebalancing strategies that I want to cover today is with an example. And so we have this character we've made up here, Camille. She is a polyglot. She has a passion for foreign languages, and she's taught herself Danish and Icelandic using this language learning system that she's developed all on her own. And this really substitute any hobby that takes a lot of time and potentially doesn't make much money, at least in the beginning. And you have the same situation, maybe a writer or an artist or a musician. But the point is that Camille loves languages. It takes a lot of time to do this hobby, and it really doesn't bring in any revenue. Her friends have this other opinion that maybe if she were to start a YouTube channel and showcase her abilities, she might be able to sell ebooks or sell an online course on how to learn languages. But right now, Camille needs money. She works as a waiter. And because life seems too short for all of the languages she wants to learn, her off time really is spent studying her next language. She's now working on Swedish. And this idea of this pie in the sky dream of becoming an internet polyglot YouTube star, that's sort of staying on the back burner. Now, something interesting happens to Camille. Rich relative dies, and after liquidating all that's left to her, she ends up with $1 million. And $1 million is it's very interesting. Camille is wired a little differently, perhaps, from the average American capitalist, in that she does this quick calculation. She looks at, and I'm just picking these numbers because they're easy. They're not too far from reality. But she sees that a safe bond index yields 2.5%, and also 2.5% is about the yield on the S&P 500 on an S&P 500 index right now. So easy calculation, 2.5% times 1 million. However, she splits it up between the index fund of the S&P and the bond index. She ends up with $25,000 a year. Now, I did a quick search online. This turns out to be the average salary of a waiter, at least in the state that I live in. Pretty shockingly low. But the interesting thing about Camille is her primary objective is not to grow this money to get richer and richer and richer, or not to spend it all immediately. She's finding herself in this amazing situation where she can essentially quit working as a waiter and have the same amount of money per year to live off of. And so her primary goal is to not screw this up, to make sure she doesn't try to get richer and end up messing this whole thing up and having to go back to waiting tables. So what does this mean from a financial point of view? Well, she says, well, $25,000 is what I could get per year pre-tax if I invest this. And really, I want to take a little risk, maybe try to grow it to keep up with inflation, but I really don't ever want to drop below 800,000. So I can't really invest a lot of this in the stock market. And if I do something wrong, if the stock market goes to zero, at least I still have 800,000 making 2.5%, which is 20,000 a year. Maybe she could survive on that. But she wants what everybody wants is like, is there a way to potentially grow this quite a lot without taking much risk? Seems like it's having your cake and eating it too. Any internet research, I think, or if she just talked to people who are familiar with indexing and asset allocation strategies, I think what she could easily come away with is this kind of rule of thumb advice of don't put any more money into the stock market, into risky assets that you can't afford to lose. So that would mean something super safe, like a 20-80 mix of stocks and bonds, only 20% in the stock market. The question is that really safe? And is that the only way to do it? Let's find out. Uh, so there actually are three ways of probably more than three, but three ways that were covered at in CFA Level 3. Now, I said in the disclaimer, I am not an investment professional. That is true. I'm an electrical engineer. I did sit for and eventually pass all three of the CFA exams. I do not get to put CFA after my name, though, because there's also a work experience requirement, full-time work experience requirement that I have not done as a sort of freelancer. So it could just that's just a backstory in case you're wondering where am I pulling this material from. 2011 was the first time I took level 3, and I still have my manual from that. And we covered three types. They called them portfolio rebalancing strategies. You could also, I guess, say it's just a general asset allocation strategy too. It's not purely about the rebalancing, but the rebalancing is the attribute that sort of separates them. So there's constant mix. That's the one you've heard of, 60-40, 20-80, whatever. There's another one called buy and hold. Pretty straightforward. And then the other one's Cppi. This one was brand new. And but I'll save my comments for when we get to them. But what we want to do is to look at examples of how each of these three work and I'm going to pick some pretty extreme market scenarios. So just to see kind of what happens, because ultimately the question Camille is asking herself is there a way where I can potentially really have a lot of upside without having much downside? Let's find out. So constant mix is the one, like I said, that we're all familiar with. And we said Camille maybe is going to settle on this 20-80 stocks and bonds. And then you rebalance. Maybe it's every day, well, tax-free account, but every week, every month, every quarter. It sort of depends on the person. Other people just wait until the asset allocation has strayed too far. So maybe your 20-80 has drifted to 25-75. I think I know more people who do it the first bullet way. There's actually a portfolio manager in town here whom I know, and he just rebalances all the client index portfolios every July 4th, I think. Anyway, the desire, as we say, the kind of prime directive of the constant mix is to keep the return risk profile constant. So you keep rebalancing back to your target mix. Nothing new there, but let's look at a couple boundary cases, and I put this little yellow star up here because what I'm saying is here we're just going to assume that this is a two asset allocation. We've got a risky asset that would be like the S&P 500 index, and then we've got a no risk asset, I don't know, treasury index or something like that. And I mean, just for simplicity, I'm assuming that the no risk asset never changes in value. It just yields its coupons each year. So I mean, this is the case of the risky asset. That would be the S&P going to infinity, just meaning it goes up and up and up and up and up and up. Just some sort of crazy market. What happens to the constant mix? Well, I mean, Camille is only putting 20% of that 1 million in the market, and then every year she's rebalancing back to 20-80. You'd have to be able to see the calculations behind the spreadsheet here, but that's what she's doing. It's just like put 20% in the risky asset, 80% in the no risk asset. The risky asset is growing by 40% every year. She's not risking very much, so she only grows 8% and ends up with a slightly larger portfolio at the end of the year. Keeps growing, and after 5 years, I mean, the market has just gone up like crazy. She does have more to live off of, 37,000 roughly, instead of her initial 25,000. Here's where it gets scary. What happens if the market goes to zero? I think this is, maybe this isn't considered very often because we don't tend to live in countries where this has happened before. but it is possible that the stock market goes to zero, or at least close enough. So here I've just flipped it to where it's minus 40% a year. And you think, well, 2080 sounds safe. But if what you're following is a strategy of always rebalancing back to your target allocation, you're taking money out of your no risk asset and you're putting it in the market each year, and then you're losing it. And so you're having to take more out of your no risk and more out of your no risk. And look at this, if she did this without paying attention to the fact that she drops below her target 800,000 a year, she's all, after 5 years, she's down to trying to live off 16,000 instead of 25,000. And take this to the extreme after many of years of this, and she's been constantly rebalancing and rebalancing. The very last year she's going to have like $2 in the risky asset and $8 in the no risk asset. It's just you keep putting money in the market and you keep losing it. And I think that's an attribute. I mean, maybe it's extremely low probability, but it is an attribute of constant mix that a lot of people never seem to talk about. Here is the second strategy called buy and hold. Now, when I saw this in the CFA manual or study guide, I thought, this isn't a strategy. It just means you start off with a constant mix, and you just never rebalance it. I mean, is that really a strategy? But it is, in fact, because you never take anything out. You're more concerned with this floor that you never want to drop below. And as long as you don't drop below that floor, whatever money you have above that, leave it in the market, let it ride, see how big it'll go. And this sort of ties into, this might be kind of an urban legend, but there's this story that one of these asset managers, maybe it was Fidelity or somebody, looked through all of their client portfolios to figure out what were the strategies of the people who were earning the best returns over time. And at least the legend goes, they finally found the answer after a lot of research, and it was the people who forgot they had portfolios, or the people who were dead or something like that, because they weren't sort of moving money around and trying to rebalance or anything. They were just letting it ride, not reacting to news and stuff like that. So buy and hold. What happens to it if we put it through the same paces? We're looking first with the market going to infinity, and what did we end up with? Let's look a couple slides back. Camille ended up with 36,000 after 5 years doing constant mix. Now with buy and hold, 47,000. So she's only concerned with keeping this 800,000 in the no risk asset. And if the market's going up, she lets it ride. That's fine. And look at that. She has a lot more to live off of after 5 years when the market did that. She didn't really have to worry, hopefully, too much about fear of missing out as the market's rising. At least her portfolio is rising too, not as much as the market, but she is participating. And the other case, of course, the market goes to zero. Well, it doesn't really matter. She never rebalances. So at the end of this time, she does end up very close to her floor, but this could go to zero in the market. It doesn't matter. She's not going to touch it. She's gonna what would you say? Not max out, but min out maybe. The lowest she will drop will be to a 20,000 from her 800,000, like we said. And you never think about that when it can be tough for people to rebalance, or to take money out of your safe index and put it in the stock market when it's a year like 2008, 2009, or March of 2020, if that happens to be when you're doing it. I mean, that can a lot of people will sort of balk when it gets to that and be too afraid to do anything. If you had this sort of asset allocation, just don't worry. Your risk profile changes. It's the more, if your portfolio goes up in value, its volatility increases with it. But if your sole thing you're concerned about is not losing this cushion here, doesn't matter. That is an attractive aspect of buy and hold. And I don't hear of people doing it, but I'm sort of surprised. Maybe it's because people are more focused on making money than losing money. I'm not sure. Finally, we have Cppi. This rebalancing strategy. The first time I read through the description on how it works in the CFA guide, I thought I must have read it backwards, because it sounded like the more the market goes up, the more money you're putting in the market. And it's like, that's no, you're supposed to take it out of the market when the market goes up. You're supposed to have contrarian, this contrarian of selling what has appreciated and putting it in the underperforming asset. And this just sounded like something from the dark side. Like I said, I first thought I'd read it backwards. Then when I understood it, it sounded like some sort of momentum thing that could possibly really bite you if the market turned in the wrong direction and you've been betting more and more and more as the market goes up. But it has a very interesting aspect in that as the market goes down, you also take money out of the market. And in doing that, you can almost sort of have your unlimited upside and have your limited downside. It does require you to monitor the portfolio. It requires two things. You need to be on top of this portfolio, watching it, in case it moves too far, especially in the negative direction. And the other thing to do is when you pick the time frame in between which you're going to be checking in with it, it's great if you're going to check it every day, but maybe realistically you're only going to be able to check in with it once a month. You need to estimate ahead of time what is the worst expected drop that the risky asset might experience before you can react and do something. Because what we're worried about is the market turns against you and it starts going down. And you need to be pulling money out of the market as this happens, so that you never drop below your cushion of 800,000 if it really dives. So it requires some monitoring, and it requires some judgment of like how much could the market move against me before I can react. If you do that, then you'll see the math shows something very, very interesting here. And we have this formula here. This is the amount that you put in the risky asset. You might have to sort of take this until you see. Let me intuitively explain it. So you have 1 divided by the worst expected drop before you can react, which depends again on how much of a maximum drop you might see before you're able to log in and sell. So you have this estimate here. Maybe this comes from like the historical worst drop in a single day if you're going to be checking in with it every day, and then but you do a multiple of that, 1 divided by the worst drop. So if the worst drop's 50%, 1 divided by 0.5 times the difference between your floor value, that's your 800,000, and then just the current portfolio value. You almost have to see it in action with numbers. So here's our CPPI. One thing here is that I'm only rebalancing once a year, and like we talked about, you want to stay more on top of it than that. Is just to keep the numbers at the same pitch as the other 2 strategies we looked at. And here's where you can sort of appreciate where this multiple comes from. I'm assuming, you have to make this judgment call. Hopefully you get this right. That the worse the market can drop before I'm going to react, and I'm only going to react once a year, is a 50% loss of the risky asset. Now, I don't want to drop below 800,000, but if the worst that can happen is that whatever I've got in the market gets cut in half, then look at the first year. I could put 400,000 in the market, only 600,000 in my no risk asset. Why? Because the worst I'm assuming can happen is this 400,000 gets cut in half to 200,000. 200,000 plus 600,000 is 800,000. Therefore, as long as I can react in time and sell, if it drops to my minus 50%, then I can actually put more in the market than I can afford to lose, which just sounds crazy. But that's, you go through the numbers and it works. So look at what we do here. We, like I said, the first year we end up putting 400,000 in because the worst that can happen is it gets cut in half. And then, the market goes up, we make money. Now we can put even more in. And then we end up, you actually, if you don't correct the table, you end up getting negative numbers here, meaning you're borrowing to even, bet even more in the market. I just put in a limit to keep that from happening. But, look at this. After a time, we eventually get to the point to where we're keeping nothing in the no risk asset, because if these numbers get cut in half, they're still far above 800,000. So we're betting more and more the more the market goes up. And look at this, salary of sorts she has to live off of now, almost $100,000 a year. For this case, when the market goes up and up, what if it does the opposite? This is when we get scared, because it seems like, wow, you've got more in the market than you can lose. So this could just like turn around and bite you. And what happens? Well, pretty quickly as the market starts going down, you end up having less and less and less and less and less in the market, such that at the end of the 5 years, I mean, $640 that we're putting in the stock market, and all the rest here is still in the no risk assets. So doesn't this strike you as interesting? It's like the market goes up like crazy, you participate and potentially make quite a lot of money. The market goes down like crazy, you're pulling money out as it's going down. So you have very limited downside, and you have potentially unlimited upside. So even using this crazy pseudo momentum leverage, seems like sort of strategy, Camille never drops below her 800,000. And as I said, the key here is you got to call this right. And I mean, even to check in with it daily. I mean, maybe during really turbulent times you want to check in hourly. I don't know. So let's review the boundary cases that we saw. There's the constant mix, and I don't know, I added the table here on the right just because, actually I started with the table on the right, but it's kind of hard to see the differences between the blues here. But the point being is that constant mix, if the market goes to zero, you're rebalancing the whole way down. Whereas buy and hold and CPPI, implemented correctly, will get you out at your floor, and also allow you to participate in upside potentially by quite a lot. Let's review what we've learned here. So there are other portfolio allocation strategies besides just constant mix. And if it's like a secular uptrend or secular downtrend, that's the interesting case, because constant mix actually will underperform in that case. Now, the case we did not show, perhaps that's the more typical case, is the stock market sort of going up but correcting, and then going up even more, and then maybe correcting and going up even more. That is actually where constant mix outperforms. And perhaps the reason everyone uses constant mix is that is perhaps a more typical serial run of years, is the market goes up a little bit, maybe has a down year, goes up more. I mean, in that case, constant mix does exactly what you want. You're going to be selling when there's selling at peaks, and then you're going to be buying dips, and that will result, if you run the numbers, in a higher return for that sort of oscillating up market than you will get using CPPI or using buy and hold. But maybe the next to last bullet here is that once you've reached a certain level of wealth, for some people it can become more about wanting to preserve. It's not so much about like maintaining the same risk profile or same volatility, or it's more about like, I've earned a certain amount, I don't want to lose that, and yet I want that to grow somewhat to keep up with inflation. Are there ways to do that? Potentially participate in upside and not participate in downside so much, limit your downside. The answer we saw is yes. Final bullet here is CPPI. That I don't know anyone that does it. The emotional part of my brain really doesn't like it. But what did you see when you looked at the math? Huge potential upside, limited downside. Sounds like something I would talk with my financial advisor about. So what do you think? Let me know in the comments. Till next time.